Dividend stocks beat the market. Research proves it time and again. But which dividend-paying stocks are going to give you the highest yield and return on your money? In this video, I'll not only rank the top 5 dividend stocks, I'll reveal 4 dividend investing risks that will destroy your portfolio. We're talking high dividend stocks today on Let's Talk Money. Beat debt, make money, make your money work for you, creating the financial future you deserve. Let's Talk Money. Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your time to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now you know I love dividend stocks and it's a big theme here on the channel. I get a lot of comments and questions about some of the highest paying stocks, the ones with those double-digit dividends. So I wanted to make a video ranking some of my favorite dividend investments. Now those of you in the community know I'm not about just laying out a list of stocks to invest in. I will reveal those 5 high dividend stocks, but I also want to give you the tools to find your own and make those better investing decisions. Now that means knowing the 4 risks to watch out for in these high yield investments. 4 dangers to dividend investing that you absolutely cannot neglect. First of these is going to be also to look at that payout ratio for a stock. Now this is the percentage of the profits a company pays out to cover that dividend. Pay out too little and it's probably not much of a dividend stock. Pay out too much and it will seriously limit any future growth and may actually cause the company to fall behind the competition. Finding the payout ratio is actually pretty easy. You just divide the annual dividend amount by the earnings per share. Now a safe ratio is going to be different for each sector. So safety sectors like utilities and telecom are going to have higher payout ratios, while growth sectors like tech tend to pay out less. So just make it a point to compare that payout ratio for a stock with some of the others in the same sector. Our next risk, and this one is especially bad for investors reaching for those really high dividend yields like we'll talk about, and that's exposure risk to just a few business structures. You see, there are a few types of businesses, specifically business development corporations or BDCs, which lend out money to small and medium-sized businesses, master limited partnerships or MLPs, which hold energy assets like pipelines and storage, and then real estate investment trusts or REITs, which hold commercial real estate. Now, these 3 types of businesses tend to pay out almost all their profits as dividends. In fact, they get tax breaks for doing so. And these tend to be the highest dividend yields you'll find. The risk is that if you're only searching for stocks with very high dividend yields, then you're probably only investing across these 3 business structures, these 3 sectors of the economy. Now, all 3 of these are highly sensitive to interest rates, so when rates increase, it tends to hit these stocks harder than the rest of the market. You've also got risks within each of these, like a steep drop in oil prices for MLPs or credit risks in those BDCs. The point is you need to hold more types of dividend stocks than just these in these 3 business types. Our third big risk to watch for is just focusing on that dividend yield alone. Understand that a high dividend yield is still no guarantee of a positive return. You see a lot of these really great dividend payers with yielding 12 or 15%, but the stock price goes nowhere and sometimes even falls as much as that yield. This is something that we'll see in that ranked list of high dividend yield stocks. Now, all 5 that I've selected have beaten the stock market over the last 3 years, but you'll see that that highest yield isn't necessarily the highest total return. So before you invest in a dividend stock, look into the fundamentals of the company and make sure that that company is just a good investment on its own. Our last dividend risk before we get to that list is to watch out for the high yield myth. Now, I call this one the high yield myth because you find a stock with a high dividend yield. You invest in the shares and then you see that the stock price has plunged over the last year. The problem here is that you take any stock paying a 2% dividend yield, cut its stock price by 50%, and suddenly it's a 4% dividend yield stock. It's like magic, right? Well, something is definitely wrong with that company, and when the board of directors goes to declare that next dividend, they might cut it back down to 2% or maybe even cut it out completely. So always look at what a stock price has done over the last year or two and make sure it's not just a high dividend stock because that dividend has stayed the same while the stock price has tanked. Now let's get into those 5 high yield stocks that I found, and how I started is I screened Morningstar for stocks with a yield above 6% and a market cap above $1 billion. Now what I didn't do was just go and pick the highest dividend stocks available. That would have left us right smack in front of the risks that we just talked about. So I went through each stock, looking through the fundamentals and the prospects for growth. Picks had to produce positive total returns for the last few years and have some upside potential besides just that attractive yield. I'll first reveal each individual stock that made the list and then a table ranking them by total returns. First, if you're liking the video though and the information, do me a favor and tap that thumbs up button below. So our first high yield pick here is Crestwood Equity Partners, ticker CEQP. Now this is an energy master limited partnership paying a 6.5% yield. Crestwood is the perfect example of why I say look for the total return rather than just that dividend. This is actually our lowest dividend yield in the group, but has produced the highest return with an annualized 31% return over the last 3 years. Now, Crestwood is a traditional midstream MLP, which means it owns oil and gas pipelines, processing stations, and then those storage facilities. It then charges energy explorers a fee to transport through the pipelines or store in its tankers, and you can see it has assets in all the major production zones. The company has long-term contracts with some of the biggest oil companies, including ExxonMobil, Shell, and Con Edison. Now, most of these contracts, 84%, are on fixed fees, so not subject to that volatility in energy prices. Crestwood has some great fundamentals with 30% growth expected in distributable cash flow and an industry-leading 1.5 times coverage on that DCF ratio. Now, this is a really important metric for MLPs that we've talked about on the channel. It means a company is covering its dividend by 1.5 times, so the cash flow is there and it might even be able to increase that payout a little. Our next high dividend stock is a mortgage real estate investment trust, Chimera Investment, with a solid 10.4% dividend yield. Now, this is one of the oldest and most dependable mortgage REITs out there, sending investors over $4.5 billion in dividends since its founding in 2007. Now, what I really like about Chimera is that it survived through that 2008 crisis. So management knows the risks and it's put together a solid portfolio of mortgage assets to keep that dividend stable even if the economy takes a hit. So the company invests in a great mix of residential mortgages, agency and non-agency mortgage-backed securities, and then some commercial loans. And now this chart showing the breakdown probably doesn't mean a whole lot to you, but it just shows the diversification in that company's assets. Total number of loans over 136,000 and spread across these different loan models. That's what gives Chimera its stability. Now, one of the drawbacks to these high-yield business structures, so your BDCs, your REITs, and your MLPs, is that they have to raise money frequently. They pay out almost all their profits as dividends, so raising money through preferred shares or stocks can sometimes dilute that investor ownership. Chimera has actually authorized an 85 million share buyback program, so it's actually doing something to counteract that dilution just a little bit. Now, one thing to remember about mortgage REITs is that the group is extremely sensitive to rising interest rates. First, real estate is just highly leveraged industry, so anytime those borrowing rates increase, you're bound to see a little weakness in the sector. Also though, and this has been a big weakness over the last few years for mortgage REITs specifically, is that the Federal Reserve increases short-term rates, but it really can't do a whole lot about controlling those longer-term interest rates. The problem here is that when the market is looking at a potential recession or at least an economic weakness, those longer-term rates don't rise as fast as the short-term rates when the Fed is hiking. Now, mortgage REITs borrow in those short-term rates to buy those loans with longer terms. So what you get is higher borrowing costs in those shorter terms without much of an increase in the interest that they're collecting on those longer term assets. This might not be a problem for a few quarters because the Fed has already come out and said that it's pretty much done hiking rates for at least a year. But just understand and be ready for a little bit of pain in mortgage REITs every once in a while when those interest rates are increasing. Now, our third high yield pick is one of the few stocks outside MLPs, REITs, and business development companies. AllianceBernstein Holdings is an asset manager with more than $500 billion in assets under management, pays a strong 6.6% dividend. Now, what I really like about AllianceBernstein here is that it gives us some diversification in that high yield list. AB manages stocks and bond funds with 51% of assets in fixed income funds, another 38% in equity funds, and then the rest in alternative assets. I like that position in fixed income funds because I think it's less prone to the trend in passive management that we've seen in stock investing over those last few years. It's got a strong international reach with 45% of revenue through that global investment services. The dividend payout hasn't been quite as consistent on this one, so the payment has bounced around, though the yield is fairly stable. The company reported a strong pipeline in institutional assets last quarter of $11.4 billion. So this is money committed to new funds that the company is going to be rolling out and a big opportunity for fee growth. So with AllianceBernstein, not only do you get a solid dividend yield and good investment, but you get to diversify your portfolio a little bit from those REITs and the MLPs that usually find dominating a high yield list. New York Mortgage Trust is another MREIT and pays the highest yield of the group with a 12.7% annual yield. So this one is going to be similar to Chimera Investment in that the company invests in different types of mortgage debt. Now, New York Mortgage focuses a little bit more on multifamily properties and has a larger portion of its portfolio in distressed property debt, so maybe a little bit riskier, but also has that little bit higher yield. Given the choice between the two, though, I'd probably have to say to go with Chimera, but I think you can spread your investment between the two. It's going to give you a little bit more diversification in these M-REITs and then take some of that company-specific risk out of your portfolio. Our next pick here is Sunoco with a 10.7% yield and a different business model compared to a lot of those high-yield MLPs you'll see. Now, most master limited partnerships specialize in that midstream component, so pipelines and energy storage. Sunoco operates in a downstream segment, operating in the retail and wholesale fuel stations. So not only is Sunoco a great dividend pick on its own, adding it to a portfolio of midstream MLPs is going to give you some of that diversification as well. Sunoco books 3 different sources for income. Fuel income through its wholesale operations, selling fuel to 7-Elevens and other buyers. It books rental income on over 940 locations and also books some income like payment processing, franchise revenue, and terminal operations. Now let's look at these 5 high dividend stocks ranked by 3-year total return. Again, I want you to notice here that the highest yields didn't necessarily translate to the highest returns. In fact, the 2 lowest yielding stocks produced strong annualized returns that outperformed some of the others. Notice that industry concentration we talked about in MLPs and REITs as well. So I've ranked the 5 here, but understand that these are the 5 best among 60 plus high dividend stocks that I looked at for the video. So any of these would probably make good additions to your portfolio. Now, if you want to see how I picked dividend stocks for our 2019 stock market challenge, click on the video you see to the right. The portfolio is beating the market with almost a 20% return just this year, with 5 stocks over 30%. Don't miss it, and don't forget to subscribe for more videos like this one.